Let's start. Good afternoon, ladies and gentlemen. Thank you for joining me this wonderful afternoon. Hopefully, you all had your lunch already and are ready to start this webinar. In today's presentation, I'll be talking about the second half 2022 economic and market outlook. And today I'm the presenter. I'm Jason Wong. I'm the research manager for FSMOne. I lead the Malaysian research team based in KL, and we cover mainly Malaysian, Indonesia, and Thailand markets, and also the investment products domiciled in Malaysia. So if you go to our website, some of the articles that you see, especially those Malaysia-related ones, were done by me and my team. And yeah, I regularly give webinars and market outlooks to all of you. Let's start without further ado. In today's agenda, I'll be covering these main topics. Firstly, a quick recap on how markets have done so far this year before I talk about the economic outlook, with trying to answer the big question that a lot of you may have in your mind. Are we heading into a recession? Next, I'll also talk a bit about the earnings outlook. How are earnings affected amidst what's happening or what's going on in the global economy so far? Next, I'll also talk about the market outlook. And a lot of you may have a big question in your mind, is that how have markets bottomed already? Before I move on to the positioning for second half of 2022, what are the opportunities that we see? And I'll end the session with a quick Q&A session. And if you have any questions, please do share your questions in the chat box. Then I'll try my best to answer all of the questions if possible. So let's start the presentation. Firstly, this is a chart that illustrates how the major markets have done so far this year. The white line is the global equity. So that's represented by the MSCI All Country World Index. It is down about 13%. We also have the blue line, which is Asian equities, which is represented by the MSCI Asia ex Japan Index, down also about 13%. Whereas the orange line is MSCI ASEAN Index, which is down slightly by about 3%. So overall, we had a good start to the markets initially. So you can see here, the Asian markets and China especially were on the rise. And this was a continuation of what happened they actually started to recover since mid of December. And this was a continuation of what happened, the recovery that we saw in mid-December. However, the Russian-Ukraine war happened, as you all may all be aware, and this caused some jitters in the market. As you can see here, the market started to retrace. Followed by that, there was a brief recovery before more negative developments happened, which brought markets down, like China lockdowns, ADR delisting fears, fear of possible sanctions on China, and this actually caused a big retracement that we see in the Asian and also Hong Kong and Chinese markets that we saw in March. Following that, markets became more or less trading sideways as more lockdowns happened in major Chinese cities like Beijing, Shanghai, Shenzhen, and so on. And a lot of central banks, in order to curb inflation, they started their interest rate hikes, their monetary policy tightening as well. And this caused some, especially those growth-related companies, to come down quite a bit. Malaysia also one of the countries, one of the central banks that high interest rate ahead of expectation in order to curb inflation. So these were some of the events that made markets quite choppy. Towards the mid-May, as I'll explain later, markets started to recover following that, and this was on the back of several positive developments, especially, I guess, more notable ones would be like the policy measures that China government have come out to say. Okay, they have given a conviction that they are going to support the economy amidst the slowdown that's expected because of the lockdowns in China, and also the reopening of several of the big China cities finally. And we saw a brief recovery, and until today, markets are still on the rise. This is a quick snapshot of of the major markets that we cover and also the major sectors. And you can see here, most of them are in the red. It's a sea of red across the board. Only certain markets and certain sectors manage to stay in the green. Like, as more notably will be the ASEAN markets like Singapore, KLCI, Malaysia, Indonesia, Thailand. So these were in the green. The only few markets that were in the green. In terms of sector, only the energy sector and utility sector to a certain extent did not suffer retracements. Now I move on to the economic outlook going forward. Are we heading into a recession? A lot of you may ask. If we look at some of the leading indicators that that's compiled by OECD. So OECD is the Organization of Economic Cooperation and Development, and it's a combination of some of the major developed markets and some emerging markets, except for China. China is not inside, but they still compile the data for China here. So this OECD, they come up with this leading indicator index that you can see here. And for each country as well, the blue line will be the total one, which is all the OECD members. The orange line is US leading indicator, Europe is gray, and China is yellow. So this leading indicator is a combination of some of the key leading indicator data that's available for each country. For example, like the US, they take all this information like books started for dwellings, new orders for durable goods, consumer confidence indicators, weekly hours worked, and etc. So each country, they will pick whatever important available data to compile into this leading indicator. It gives a good indication of how it's a leading indicator, so it gives a good indication of how well the economy might do, okay, going forward. As you can see in this left-hand side chart here, we have noted a slowdown, okay, since the quarter of last year, in fact. So the blue line has been trending downwards. This is mainly because of US and Europe starting to slow. And another notable fact is that China has been slowing since the start of last year, in fact. So China has been slowing much earlier than the rest of the world, the developed markets. I think partly because China was one of the first countries to fully reopen after COVID, correct? If you remember in 2020, they were one of the countries that managed to manage the COVID situation very well. And because of that, they opened much earlier than the rest of the world. So their economy kick-started earlier. And therefore, they started to slow earlier than the rest of the world, whereas US, Europe, and the rest of the world only started to really reopen in 2021. Okay, so leading indicators actually indicate that we're slowing down. Other indicators like PMI numbers, the Purchasing Managers Index. So this is a number used to track how businesses, it generally try to indicate how optimistic businesses are with the economy, with their outlook going forward. And what we want to see is more green. Green is indicate growth, and a number above 50 indicates growth here, and a number below 50 is contraction for PMI, and it's represented by red color as well. So what we want to see is a lot of green, and something notable is that the green is getting lighter and lighter, and some of the reds have appeared, as you can see here. So in the box here, I have highlighted the PMI numbers for developed markets and emerging markets. So similar to what the leading indicator that I showed you just now, emerging markets, especially led by China, has been slowing down. And in fact, in April, they have turned into contraction territory, as you can see here. So China is actually contracting in a few months, mainly because of the lockdowns. On a positive note though, developed markets are holding up much better than emerging markets slash China. If you can see here, Eurozone, United States, they're all still in positive territory. Although less positive, they dropped from 60 plus to now 50 plus, but they're still in positive territory. Other emerging markets like Indonesia are also put here. They are still generally in positive growth territory. So mainly the drag down will be from China because of the lockdowns over there. What we have seen this year, other than slowing growth, is also inflation picking up. We think that inflation will persist, okay, in the next few quarters and next few years, but expected to peak, especially this year, as the base effect starts to wear off. So if we look at some of the, okay, so this is the left-hand side here will be the inflation CPI number, blue color line, and also the core CPI index, which takes up all the more volatile components like fuel. And you can see notably that inflation has picked up way above the pre-pandemic levels. Okay, similarly, emerging markets way above. In terms of numbers, here I have a table of projections. One of the key reasons for this spike in inflation will be the spike in commodity prices, especially oil. Pretty sure you're all aware because maybe less impactful for Malaysia because there's oil subsidies. But if you look at like other countries, oil prices have been spiking a lot, and that has added to inflation. Non-fuel commodity prices have also increased. So this is basically the growth number, year-on-year growth number. So in 2021, oil prices spiked 67% and non-fuel 26.8%. It's expected to go up another 54% in 2022. Similarly, non-fuel as well. But it's expected these commodity prices are expected to come down in 2023. So that will help to see that inflation start to alleviate a bit going forward. One notable fact is that you see the projections for these commodity prices has spiked dramatically since the start of the year. So this the initial expectation from January was these numbers. So because what caused this sudden jump in inflation expectation, mainly due to two things: what's happening in Ukraine, Russia-Ukraine war, and also the lockdowns in China. So the Russia-Ukraine war did have some repercussions onto commodity prices because, as you know, a lot of markets or economies are starting to put sanctions on Russia, and they will need to source their energy resources from somewhere else, and this caused some supply-demand gaps. At the same time, Ukraine is also a major exporter of some of the soft commodities like wheat, and because they couldn't export these, so it caused other similar commodities or substitute commodities to rise as well. So this is the reason why inflation expectation has spiked since the start of the year. In terms of CPI numbers, inflation is expected to hit 5.7% this year for advanced economies and 8.7% for emerging and developing economies, much higher than initially expected. The consequence of this is that a lot of central banks are going to have to increase interest rate a lot more aggressively and earlier than expected. So in fact, the Fed has already hiked interest rate 2 times this year. And for us, we think that it's still a long way to go in terms of their monetary policy tightening. We expect them to hike the Fed funds rate to 3.75% by end of 2023, which is more aggressive than what the consensus is thinking right now. If you look at the dot plot from the FOMC members, the median one is expecting the Fed funds rate to hit 3% by end 2023, but we are expecting it to be much higher than that. As a consequence of that, other central banks around the world also need to follow suit because they cannot diverge too much from what the Fed is doing. Otherwise, there will be a lot of repercussions, like the currencies might be affected. So that's why you see even BNM, Bank Negara, hiking interest rates ahead of expectations. They hiked interest rates last month in May, which was much faster than expected because most people expect them to hike in third quarter. And other countries are expected to follow suit as well. Otherwise, they don't want the monetary policy to diverge too much. So most central banks will start to hike interest rate. Later on, I'll talk a bit more about how to position it in light of this development as well. So as I mentioned, global growth has slowed, inflation has picked up, central banks are hiking interest rates. So what's the repercussion of that is that recession risk has increased as well. So if I have a few charts here. So this is a recession probability that's compiled by Bloomberg. Basically, Bloomberg, they go around and ask economists from major banks, what do you think about the economy? Will it go into recession? What's the probability of going into recession? So this is a compilation of that data, and notably, it has increased since the start of the year. Like US, the probability of recession is now 30%. Europe also about 30%, Japan 25%, and even China, which had been like 10% for quite some time, it slightly increased the recession probability here. One thing to highlight is that although probability has increased, but if you look compared to pre-pandemic level, it's not that too much difference. Like it's about the same like pre-pandemic levels. And another thing to note is that even though recession probability has increased, that doesn't mean that recession will happen for sure. Okay, it's just a probability, right? 30% probability, but it doesn't mean that it will happen. And in fact, it will take a black swan event, I would say, to trigger a recession. Because if we see historically, this is since 2007. And the technical requirement to consider that the economy goes into recession is that 2 quarters of negative GDP growth, correct? Negative GDP contraction will only be considered as recession. If we look historically, it would take a black swan event, like for example, GFC, global financial crisis in 2008, to trigger recession, or COVID in 2020, where the whole world basically stopped to trigger the recession. At the moment, economists are still forecasting growth, and like between 1.6% to 2.8% kind of growth for the next few quarters. So although recession probability has increased, does not mean that recession will happen for sure. And if you look at the growth number, it's not too bad actually. You can't expect basically these few quarters of high GDP growth numbers are a reversal of the recession that happened in 2020, the COVID period. Okay, so you had a low base here, and this was a rebound. But you can't expect these kind of numbers to it's not sustainable, especially for a US economy, such a big economy and a developed economy like that. It's basically gonna move towards a more normalized growth era. And if you look at historically, right, they have been growing around this number for the past decade anyway. So it's quite a normalized growth environment for the US. It's slowing because of the high base effect that we saw in 2021 and 2022 post the COVID pandemic recession. Okay, so in short, global growth is expected to slow to 3.6% in 2022 and 2023 from 6.1% in 2021. So once again, this was a jump because of the recession that we saw in 2020, the post-pandemic jump. And we can't expect this 6.1% to, you can't achieve 6.1% sustainably every year. So we're now moving towards a more normalized growth era. In terms of by region, all the regions were downgraded, in fact, in terms of growth numbers, but emerging markets and developed economies were downgraded more, okay, from the start of the year. And this was mainly because of China. So ultimately, what's happening in the China lockdowns do affect the economy in China, and also some parts of especially those trading partners that trade a lot with China. However, despite the downgrades, emerging and developing Asia still remain the fastest growing region, 5.4% in 2022 expected, and 5.6% next year. And you compare this to the rest of the world, it's still posting the highest growth among the major regions. Next, I'll talk about earnings outlook. So just now I talked about slowing global growth. How would this affect corporates? How would it affect corporate earnings? Before I move into that, let me show you a few charts. This is a chart of the global equities, MSCI 8 all country world, since 2002, 20 years ago until now, the white line. And it's plotted against the blue line, which is the earnings per share for all these companies in the MSCI world. And we can see a notable positive correlation between the two. That means they tend to move in tandem with one another. In terms of percentage, global equities grew by 8.1% per annum since 20 years ago, while earnings per share grew by 9.3% per annum. So in other words, earnings growth is a key driver for global equity performance. That means if earnings do well, the share price should do well also for the companies. Next, we have Asia, which basically is the same thing. In the past 20 years, Asian equities gained 8.7% per annum, whilst EPS grew 8.6% per annum. So for Asian equities, earnings growth is still a key driver for performance. Lastly, we have China. So China equities against China corporate earnings, and likewise 10.1% per annum in terms of the index movement, whereas earnings for Chinese equities grew 8.9% per annum. Next, this is the year-to-date earnings expectation, okay, for each region. So how do you interpret this? Is that since the start of the year, analysts were expecting companies, let's say in global equities or US equity or Asian equities, to earn, let's say $100, okay? And since then, how has the expectation of the $100 changed, which will give a indication of the health of the companies. So let's start with the white line, which is global earnings. Actually, it has been upgraded. So that means at the start of the year, analysts were expecting global companies to earn $100, but by end of May or early June, they're expected to earn close to $102. So it's better than expected. And this is mainly anchored by US and also Europe. As you can see here, earnings for US and Europe were upgraded, in fact, especially Europe, 10% up. On the other hand, Asia and Japan earnings were downgraded by about 5.5%. Okay, there's a diverging earnings revisions for each region since the start of the year. So if we look at US companies, because just like I mentioned that US companies did better than expected. And no surprise, so Bloomberg, they actually compiled this data here to see how many companies did better than expected or meet expectation or went below expectation in terms of sales and earnings. Okay, and what we want to see is a lot of green here. So green is good thing and the red is not so good. And in terms of numbers, about 66% of US companies reported better than expected sales, and 76% reported better than expected earnings. So a lot of companies are doing better than expected, and this contributed to the earnings upgrade that we saw just now. Similarly, Europe also, a lot of green, you see. And in fact, if you're interested, you can see which are the sectors that outperform more and which are the sectors that underperform. Okay, 72% of companies did better than expected in terms of sales, and 64% did better than expected in terms of earnings, with an aggregate surprise of 9.5%. So they surprised, and they surprised by a lot for European companies. Therefore, you saw the 10% EPS upgrade in Europe. On the other hand, let's look at Asian EPS right now. So Asian, in terms of earnings, have been quite diverging as well. China and Korea have been revised downwards, whereas tech-heavy Taiwan is upgraded by 10%. They outperform. If we look at the Bloomberg compiled data, Chinese companies have had mixed performances since the start of the year. In fact, a lot of reds, as you can see here, right? More negative than positive. So that's why you saw in the previous chart, Chinese equities were downgraded. Chinese earnings were downgraded by about 12.5%, mainly because of the lockdowns that's happening over there. It does affect businesses because ultimately businesses, they can't do business. Their revenue and earnings will be affected. Taiwan, on the other hand, there are more greens and more whites. Whites are basically meeting expectations. So yeah, Taiwan companies are doing better. All in all, despite the revisions, okay, this is a compilation of global, US, Asia, and Chinese earnings, and the past earnings and also future earnings forecast, it's quite solid going forward, still positive. So we mentioned that global equities in terms of the earnings are quite healthy, and in terms of percentage, we have it here. About 11% growth this year, 7.9% next year, and 7.6% the following year. And it's mainly anchored by US corporate earnings, quite healthy. On the other hand, Asia and Japan, despite the downgrade that we saw just now, they're still expected to post positive earnings growth this year and rebound in the next 2 years, double-digit growth, led by China. Okay, so earnings outlook still quite positive going forward. So if, let's say, share prices have dropped a lot, but the earnings have remained quite robust, quite decent, that means valuations have become cheaper. Because if you follow value, if you're a value investor, PE will probably one of the criteria or the metrics that you look at. So if the P drops a lot, well, the E doesn't drop as much. So that means the overall PE is even lower. It has become cheaper. The big question you will have in your mind is that, have markets bottomed? Let's start with China. So Chinese equities had a bad year this year. In fact, it's a continuation of the drop from last year. Initially, they retraced beyond fundamentals. So as I mentioned, this white line will be the China equity performance, and the blue line will be the EPS for Chinese equities. And it initially dropped more than the earnings downgrade, but subsequently, because of the recent recovery, it's more or less in line with fundamentals already. The recent developments in China that I mentioned just now, the China government coming out and also the reopening of China cities, have contributed to the positive rebound, positive recovery, and also the stabilization of earnings. So you saw this dip here in terms of earnings expectation for Chinese companies, followed by a more or less stabilization, and this has helped the market recover, which means that a lot of the negativity have been priced in already. Okay, all these lockdowns and also what's happening in Ukraine and China, Ukraine and Russia have been priced in already, and we see the stabilization here and a subsequent recovery over here in terms of the equity market. In terms of valuation wise, as I mentioned, the P has dropped a lot from last year, but earnings wise is still quite resilient. So in terms of PE, currently they're trading at 8.9 times forward 2024 earnings. Okay, 8.9 times here. And this is below the 20-year historical average, this red line over here. So now they're trading at below historical average and also way below our fair PE for the market of 14.5 times. Some of you may argue that, yeah, in the past it has traded like at even cheaper levels, as you can see here. Of course, GFC level is unprecedented market correction. But over here, 2011 and 2016, the PE have been actually lower than current levels. But I would argue that the period that in the past, okay, the companies inside the Chinese index are much different compared to today. So in the past, a lot of the big Chinese companies, the major ones will be those banks, insurance companies, state-owned enterprises, and so on, which tend to trade at lower valuations. Compared to today, if you talk about China, there are a lot of technology-related companies which tend to trade at higher valuation because of the higher growth, right? You can name it like Baidu, Alibaba, Tencent, Meituan, Xiaomi. All these tech companies are big constituents in the Chinese index right now, like JD.com as well. So in terms of valuation-wise, I don't think we'll reach last time that kind of level because of the composition and change. And in fact, this is already a very cheap level for Chinese equities. If we look at some of the individual companies that are trading at cheapest levels since their IPO, so a lot of opportunities over there as well for investors who like China's long-term story and also they like the innovation that's going on in China. In terms of next, I talk about Asia. Asia equities have fallen much more than what we see in their fundamentals. the blue line will be the earnings of Asian companies dropped about 6.7%, and the index dropped 13.7%. So they have dropped much more than fundamentals. And basically, what we see in the recovery recently, similar to China, is that there's a stabilization in the earnings downgrades, means a lot of negativity has been priced in already. In terms of valuation wise, currently they're trading at about 10.3, 10.4 times forward 2024 earnings. This should be 2024. It's also below historical average level, 20-year historical average, and way below our fair PE of 16 times. So it's many multiples cheaper than our fair PE. That means there's a lot of upside potential over there as well. On the other hand, global equities, as you may follow US market, tech index as well, they have all retraced despite earnings being upgraded. So I would contribute this to the multiple compression rather than deterioration of fundamentals. So corporate earnings in global equities are still doing okay. It's just that in the past, their valuations have gone up too much. So if you believe in mean reversion of valuations, you tend to revert back to the historical mean. And because the valuations have gone up so much, okay, now we're seeing a multiple come down already, multiple compression. In terms of PE, okay, similarly, they are currently trading at 13.4 or 13.5 times forward earnings. And this is still slightly above the historical average of PE. And definitely compared to here, it has come down quite a bit, and I would call it come down to reasonable levels right now compared to before when they were expensive. In fact, if you have been following us, we have rated like the developed markets like US 2.5 stars, digital economy 2.5 stars for I think since last year or early last year at the time, because we thought the valuations were expensive. So now it has come down to quite reasonable levels. So possibly we'll be looking to upgrade them in the near term as well. Okay, so here I have a table that we compile the major markets that we cover, and we rate them a star rating from 0 to 5 based on how much we like the market, and it's based on the fundamentals and also how much upside potential there is for each market. Okay, so the more stars, the better. And you can also see other data here, like for example, the forward PE ratio for each market compared to the fair PE that we assign for each market, and also the earnings growth for each market to see how healthy the company's fundamentals are, and also some dividend yields, which could add to the total returns of your investments. Yeah, so the dividend yields will also add to the total return of your investment, in addition to the capital gains, the potential capital gains, if let's say the markets revert to the fair value. Other than fundamentals that I mentioned just now, another thing that I've noticed recently based on my observation, although we seldom talk about technicals, but in this case, I find it quite interesting because it doesn't happen often, and it's worth highlighting, is that if we look at RSI, Relative Strength Index, for the markets, it could suggest that markets are on a reversal and we could be in for a multi-year bull run. What we see here is I have a chart of MSCI All Country World, white color line. There's a smaller line here, which is the RSI index, Relative Strength Index, Relative Strength Index indicator. So historically, in the past 20 years, this is a chart since 2002. This does not happen often, but whenever it happened, it coincided with a reversal in the market and a multi-year bull run. So, for example, it had for MSCI All Country World, it has happened 5 times before. This is the 6th time that this indicator hit. Basically, if this bottom line or bottom chart touches the green line, it suggests that markets are oversold. And this has happened 5 times before. This is 2002. This is a post.com bubble. Then 2000, it subsequently it went on a bull run here. 2008 global financial crisis rebound. 2011 was the European debt crisis. You see rebound here. 2015 was the China hard landing and also the China circuit breaker recovery here. And then 2020, the most recent one, COVID pandemic. So this is the sixth time that this has happened in the past 20 years. This doesn't happen often, but in the past 5 occasions, it does result in a market reversal. Next, we look at technicals for Asia ex Japan also. Similarly, this doesn't happen often. This RSI indicator hit, and it has happened 6 times before. And you can see after each time, markets do recover. China, it doesn't happen often. It is even rarer compared to the previous 2 indices. This in the past only happened 4 times. This is the 5th time this has happened, and subsequently you can see similar trends. Next, how to position for second half of 2022. The first one, as you know, as what I mentioned just now, inflation is expected to persist, although it's expected to peak and then come down a bit, but it's expected to remain relatively high compared to the previous years. In my opinion, inflation is not necessarily a bad thing. Okay, so just an analogy. If let's say you know that tomorrow the prices will drop, would you buy the thing today or would you invest today? No, right? And the next day, if you know the following day that prices is gonna drop even further, you will also not invest, you will also not buy. So it creates a virtuous cycle. So deflation is a bad thing. That's why a lot of central banks, you always hear them say they want inflation, they want to boost inflation, and a lot of them put a target of around 2% because they don't want inflation that's too high. They want some inflation, and they don't want too much inflation, and don't want like zero inflation or deflation. So on the other hand, if let's say you have inflation, you know that prices are going to go up tomorrow, you would buy the thing today, right? And you would invest today, right? So inflation is a good thing in that sense. So in an inflationary environment, okay, so central banks have always had this target, and for many years, for the past decade, they failed to achieve it. But finally now they have inflation, but it has overheated, and therefore they need to go into monetary policy tightening or aggressive rate hikes to tame this inflation, to bring it down a bit. So amidst this inflationary environment, one of the things that how you can position a portfolio or invest in is basically look for companies that are price setters, what I call price setters, and avoid price takers. So what are price setters? What are price takers? Price setters are companies that can price their products. Yeah, they can price their products accordingly to inflation, and the customer base will still be there. Okay, people will still buy their products. This is the inelasticity of all these companies. The price they have the pricing power. Okay, and by having the pricing power, they can increase the prices accordingly to their based on their input costs and so on. They're able to maintain their margins, so they continue to earn the same amount or more. Some of the examples include, like recently, these are snippets from news. TSMC, Taiwan Semiconductor Manufacturing Co. So they are the best chip maker in the world. All the big companies, your iPhones and so on, buy their chips from them because they are the best. Nobody else can do better than them. And because they have this strong market positioning, they have this strong unique value proposition for their customers, they are able to increase prices, and their customers have no choice. So if Apple, they want the best chips for their phones, they only can buy from TSMC. And if TSMC increase prices, Apple have to take it. And on the other hand, Apple, they can also increase their prices accordingly. And I would expect their sales to still do okay. If you are a long time Apple iPhone user or iPad user, they have been increasing prices every year, right? All their new products will be priced higher and higher. It's because the customers who buy the products, they tend to be more affluent customers, and they can afford the small increases in prices. So this way, Apple can maintain their margins, TSMC can maintain their margins. But on the other hand, companies that are price takers, if they increase their price, then the customers go somewhere else, those would be considered price takers, and they are at the mercy of their input costs. Let's say commodity prices go up, so that this will affect their margins and their profitability, right? So what we want to invest in the stronger companies, and a lot of your fund managers or the funds that you invest in are already doing this for you. So they're already looking for the companies that can do this. Another example would be like LVMH. So if you read the news, they have hiked the prices of their luxury goods, and immediately you saw like people queuing up at the stores to snap up all the products before they increase. So companies like this, they can increase the price because they can. Okay, at the same time, increase their profits, increase their margin, or maintain it at least. On the right hand side, we have another recent news. This is Lego. So Lego recently announced they are not a listed company, but they are super profitable. Okay, their margins are super high, and they announced that they're gonna increase prices. Okay, despite the record profit. Why? Because they can. So even though they increase prices, people will still buy their products. So this is the unique value proposition that all these examples companies have. So this is where you should be positioning yourself, and this is where a lot of fund managers will be positioning as well. Next one will be avoiding highly leveraged companies. So as I mentioned just now, we are in an interest rate hike cycle. So a lot of central banks will be hiking interest rate to curb inflation. As a result of that, your borrowing costs will increase. So if you have a mortgage, you have a housing loan or some other loans, your borrowing costs will go up according to the OPR hike, right? So Bank Negara is expected to hike a few more times this year and also next year. So your borrowing costs will increase. At the same time, other central banks like Australia also hiked yesterday, UK, Euro is also highly pressured to increase the interest rate, and other countries as well, except for China maybe. But most of the countries are expected to hike interest rate. So what will this impact? How will this impact companies is that if let's say the companies have a lot of debt or they borrow a lot of money, their borrowing costs will go up. Right? If they issue a lot of bonds, they need to refinance the bonds at higher coupon rates. So this will affect the profit because they need to pay more interest, right? So this will affect the profit. So highly leveraged companies will be affected more. So fortunately, a lot of fund managers will also be eyeing all these leverage ratios. There will be eyeing companies that have stronger balance sheet, less dependency on borrowings, this kind of thing, and also which would have less impact on their profitability. So fund managers, if they're doing their job, they'll be avoiding these kind of companies as well. Next will be value stocks. Recently, or even start of even in 2021, we have seen a rebound in value stocks. Value stocks have been outperforming growth. If in the past, value has underperformed growth for quite some time, like if you can see this right-hand side chart here. So this is a global value versus growth, the outperformance and underperformance. So if it's going down, means that value is underperforming versus growth. But recently, we have seen a outperformance of value compared to growth. So historically, value has tended to outperform growth during rate high cycles. Okay, so here we have 5 examples. This is 1980s, 1995, 2000, and 2005, and the previous rate high cycle that we see value has outperformed growth. Okay, within the rate high cycle environment, and most recently, this year basically, value has started to outperform growth as well. So it's still early days in the rate high cycle, so there's still potential for value to outperform growth going forward. So if your portfolio is overly skewed towards growth, perhaps you should diversify away from being overly growth oriented and add some value exposure as well. So one way to identify whether your portfolio is overly growth is you look at the fund name. If your fund name has a lot of growth, that means your portfolio is quite skewed towards growth. Okay, fortunately, a lot of fund managers, okay, as well, if they have a general, not like, let's say like I'm only invested in growth or something, they tend to have a barbell approach strategy when they are constructing a portfolio. They'll have both value and also growth in their portfolios. So the fund manager would also be doing this already. And you can see that in the allocation, in the sector allocation, in terms of portfolio, the changes over time, okay, especially recent times, has been shifting this already. Okay, so fund managers are doing their job as well. Another way to identify whether value or growth oriented, one way is to see sector allocation as well. If we look at, we just use MSCI World Value Index compared to the typical, the general MSCI World, you can see that the value index is more overweight in cyclical sectors like energy, financials, and energy and financials, basically, or materials or industrials. So these are typically the value stocks that are out there right now compared to the MSCI World. The value index is overweight all these sectors. So if you notice that in your fund manager's fact sheet, that a lot of the fund managers are already shifting more, doing this shift as well. Okay, so it doesn't mean that completely avoid growth. Okay, we still have positive outlook on growth, but it's good to have a barbell strategy or barbell approach. In fact, this market retracement has brought valuations for a lot of growth companies, like tech companies, to very reasonable levels as well. So definitely there's a lot of opportunity to pick over there, those, especially those strong quality growth companies that are out there. Okay, so it's just, well, the point of this slide is to show that you can't be overly growth oriented. It's good to have both. Next, look for beaten down assets with good fundamentals. So the market retracement, I would call it indiscriminate sell-off. You saw in the first few slides, basically all the markets were sold off, all the sectors were sold off, right? So it's quite indiscriminate. Good companies, bad companies also were sold off. But it has created wondrous opportunities again now. And long-term value investors, they are pouncing. One example will be Warren Buffett. Everyone knows Warren Buffett. And if you know he has been holding cash for a very, very, very long time. In fact, at the end of 2021, he held 146 billion B, okay, of the US dollar of cash in his Berkshire Hathaway company because he couldn't find things to buy. But in the first quarter of 2022, he threw in like 50 over billion to invest. Okay, that's like more than 1/3 of his cash pile. And that is just first quarter, because in the second quarter, markets retraced even more. So I'm quite sure he would have gone into the market again. So if you know Warren Buffett style, you buy good companies, just hold them, and they give you a good. He waits for good opportunities like that. So he's just going big, and yeah, he has been holding cash for so long. Finally, he got a chance. So if you are like Warren Buffett, got a lot of cash power there, waiting for the chance, now is your chance. He has already done it. Okay, so some of the things that he bought, like Citigroup, 2.6 billion, Paramount, 1.9 billion, Ali Financial, and also he bought energy companies, Chevron, Occidental, HP also he bought, Activision Blizzard. So he invested big during the sell-off. So a lot of you may ask, what are opportunities right now? In fact, the market retracement has increased the upside potential for many markets. And here we have two charts. Left-hand side chart is the PE, the forward PE 2024, compared to the fair PE that we have for each market. And the right-hand side chart is basically the upside potential that we assign for each market. The most attractive one will be on the left-hand side, and then the least attractive towards the right-hand side. Okay. And it's very obvious the biggest opportunities are found in Asia. China, Taiwan, Asia. I've shown you a few charts on Asia and also China just now. Hong Kong as well, So these are where the biggest upside potential now. Of course, markets don't just move on a straight line go up. So recently there's a market recovery already, but I would say most of the upside is still more or less around there. Okay. What are the potential catalysts for reversal in the markets, which I see or which I think are? What we saw since the start of the year is global growth slowing down, inflation kicking in, and also a slight downgrade in earnings. But what we think is that a lot of negativity have been priced in already. Okay, so you see a stabilization of earnings downgrades, and if let's say things start to do better than expected, then you see an uptick in earnings revision, and this could be a potential catalyst for markets. Okay, because a lot of negativity has been priced in already. If there's some positivity, then you see earnings start to come back, and then like things do better than expected, and the market recovery will be swept up. Another potential catalyst. So since the start of the year, we have this Russia-Ukraine war, which has dragged down investment sentiment. Okay, because some investors might be thinking, oh, it's going to go into World War III, and then things will turn bad, or oil prices are going to spike to $200, this kind of thing. So a lot of negative sentiment has already been priced into the market retracement that you see here. So if Russia-Ukraine war stops, definitely is a big boost for markets, correct? And if we look historically, right, this is not the first time we have seen war. You got Afghanistan war, Bali bombing, Iraq war, London trade bomb, Russia-Georgia war, Boston bombing, and Russia also invaded Crimea in 2014, right? So this is not the first time we saw this geopolitical tension. There are market retracements, market did drop, but subsequently market does recover, especially after the war the war stopped and it becomes a non-event. So this is a potential catalyst. Okay. The third one is that inflationary pressures alleviating. Another thing that's dragging down market right now is the inflation. So a lot of investors are concerned that inflation might overheat, like overshoot, and also central banks would be overly aggressive, which would dampen growth. But if inflationary pressures do alleviate, which is what we think will happen because of base effects, and it will persist, but it will start to plateau and come down. Okay, it will help the sentiment as well. Okay, and we do not need to wait until like the inflation number will go right down to this level before markets start to become positive again. In fact, some peaking, some plateauing, or some dipping already, I think markets will be quite happy. So in other words, the monetary policy that the central banks are doing is working, and they may not need to be as aggressive. Okay, so these are the potential catalysts for the markets that possibly haven't been priced in. So therefore, markets are still quite low right now, and you can't really wait for this to happen before you go in, because by the time it happens, you already be priced in already. So these are some of the catalysts that I think would be positive for the markets going forward. Let's watch out for those in the future. See whether we are right or not. Lastly, key takeaways for the whole presentation. Firstly, I have in terms of economic outlook, inflation is expected to persist, but it will peak as the base effects wear off. Monetary policy tightening is inevitable. Definitely, they need to hike interest rates in order to curb the inflation. This could cause recession risk to increase, but it doesn't mean that recession will happen for sure. Global growth has slowed to 3.6% with downside risk lingering. In terms of earnings outlook, despite the revisions, earnings outlook still positive going forward, anchored by solid US earnings. Asia ex-Japan earnings remain robust, with China expected to rebound strongly next year. Market outlook, the market retracement has increased the upside potential of many markets, with the biggest upside found in Asia. Global equity valuations, they have come down to reasonable levels. It's not as expensive as before, but the cheaper one will be Asia and China, as you have seen in the charts that I showed just now, okay, they're trading below historical average valuations. In terms of positioning for second half, try to invest in price setters and avoid price takers. Also avoid highly leveraged companies in the rising rate environment. Consider if your portfolio is overly growth oriented to balance a bit with some value investments. And most of the fund managers would have already been doing this. Then lastly, look for beaten down assets with good fundamentals, which I show you the chart just now, which are the markets that have the most potential upside. That's all. I will take some questions right now. If you have any questions. Yes. I think some of these I already answered this already. Like, is China going to recover soon? Yes. If you look at the points that I mentioned just now, yes, I think China market has bottomed. Firstly, from a valuation point of view, I think it has bottomed. It's below the historical average. Firstly, and secondly, in terms of technicals, this one, yes. So in the past, this technical indicator does not happen often, but in the past it does indicate or does coincide with a reversal in the markets. So fundamentally and also technically, I think that China markets has bottomed already. And like for example, I just use Hong Kong Hang Seng Index. I think that the 18,000 plus level that we saw in mid-March, that will be the floor already. Okay, it wouldn't drop below that. Second, why is Indonesia and Thailand upside potential lowest compared to other markets? Okay, let's see. Yes, so Indonesia and Thailand, actually they've been doing well since last year. Okay, compared to China or Asia that have been dropping. So Indonesia and Thailand have held well in terms of equity market performance, and both quite in line with fundamentals. And therefore, their upside potential is not as big because the rest of the market dropped much more. Okay, so I hope that answers the question. So Indonesia, if we look at the table here, you can just refer back to this in the future. Indonesia, the forward PE is 14 times. Okay, 2024 forward PE. The fair PE we have for them is 16. So it's like 2 multiples cheaper only. But if you look at Asia, our fair PE for Asia is 16 times. Then because of the retracement, the valuation has dropped to 10 point something percent, 10 point something times. So the multiple, the upside potential is much bigger. So hopefully that answers your question. Would you say that China has higher potential compared to ASEAN? Yes, as you can see in the chart just now. With limited funds, which 2 regions would you advise to invest in? Okay, so let's say you don't have any investments right now. Okay, that means you have 0. I would suggest you start with the core portfolios, core markets, which is global and Asia, these 2. Because in global, in global fund, you already have US, Europe, Japan, all these major developed economies, major developed markets as well, and some emerging market, depending on the fund positioning. But the developed markets will definitely have. Then you top that up with Asia, which you have access to major economies like China, Korea, and Taiwan, and to a certain extent ASEAN. So it will cover most of the major countries or major markets already. If you have an existing portfolio on the other hand, then you see what is the gap that you don't have in portfolio, and you can diversify your portfolio even better. Okay, so it depends on whether you are a totally new investor or you have an existing portfolio, but you have certain gaps that you can cover. Okay, there's another question. What is the outlook for bond fixed income funds? Should we continue exposed to these 2, or should we avoid due to the increased interest rate? Okay, so bonds are an important asset class. There are a few reasons for that. So bonds, because they are different asset class compared to equities, compared to commodities, compared to private equity, compared to hedge funds, and so on. Okay, so they are different asset class. That means whatever happens in the other asset class may not affect each other. Okay, so there's low correlation between one another. And this helps in terms of portfolio diversification. Because let's say your whole portfolio is only equities and only China. So if anything happens to China, then the whole portfolio will not do well, correct? But if you have a diversified portfolio, different asset classes, then if anything happens to China, at least there's something else to hold it up. So for diversification benefit, it is definitely important to have bonds or bond funds in your portfolio. Then the next question is the percentage that you have in terms of the portfolio asset allocation, in terms of equity or bonds like that. It will ultimately depend on your comfort level. So if we normally have a rule of thumb for conservative investor, you should hold like majority in bonds and then some equity. Then if you're a balanced investor, 50-50, then if you're an aggressive investor, maybe majority like 80%, 70-80% in equities and the rest in bonds. It does help to cushion the market volatility, especially for aggressive portfolio. If you have aggressive portfolio, in market downturns like that, bonds would not drop as much as equity, right? Then you can rebalance, take some of the bond, and then average down on the equity position so that you can capture the market rebound faster, right? So that's another purpose for bond funds. So in terms of bond funds, how you should position your bond fund is that if you have been following us, we have been talking about, okay, I think there's a few, each central bank or each market, they have their own views on how they want to increase interest rate. Okay, so the Fed, they can increase interest rates based on their view of the US economy and inflation. Likewise, China also, based on the China economy, they can also increase or cut interest rates. So what we see now is US has been increasing interest rate and China has been cutting rates. So there's a divergence there. So each market got a bit different dynamics. So that's one thing. But for Malaysia, it tends to follow US one more. And what we see recently is Bank Negara hiking interest rates as well. What I think is a lot of these interest rate hikes have already been priced in. As you can see, a lot of bond funds have underperformed. Okay, they have dropped. And this is because the bond yields have already adjusted upwards. A lot of bond yields spiked. So in Malaysia case, it's MGS yield. So MGS yield from, I wouldn't say from the lowest time is about 2.something%. Now it's 4.2%. So it has gone up a lot. Okay, and in my opinion, a lot of the interest rate hike for Malaysia OPR has already been priced in. So most recently, you saw that the MGS yield spiked to 4.5+%. It has come down to 4.2% already because markets have overshot. Okay, so a lot of this already been priced in. That means how much more can the bond yield spike? I think not really that much more. I think probably the 4.5% that I mentioned just now will be the ceiling for MGS 10-year yield. Okay, so at most it will drop to that level. So the downside risk is reduced already. And in terms of upside, now you're looking at higher yields. So one thing about bonds is that when yields adjust, okay, now you're locking in the higher yields already. So going forward, I just use the 10-year MGS as an example. You'll be able to enjoy 4.2% yield going forward. But that's MGS yield, the risk-free rate. If you look at corporate bonds, they tend to have spread over the MGS yield. So you'll be getting higher yields compared to that. So I would say now is a much better time to invest in bond funds, okay, because the yields have already adjusted and already priced in a lot of the interest rate. But if you're a conservative one, you're still conservative, you're still very scared, you can go for the shorter duration one. Okay, those yields have already gone up also. Okay, so the impact on the downside risk will be less. So if you're a conservative one, you can go for the shorter duration. If you go to our fund selector, right, you can select short duration bond funds. We have an asset class called short duration bond funds. So these bond funds tend to be less sensitive to interest rate hike. Okay, but if you're a more moderate or aggressive one, I think it's a good time to go into those general bond funds with longer duration. Because of the yields have spiked a lot. How much more can it spike? I think not much more. And now you're enjoying the higher yields. Okay. Next one, could you compare downside risk of Asia versus China? Okay, I think, let's see. Sure. Okay, so I have China here. I think the bottom for China should be this here, March 15, this level. So we have already rebounded. I think after the last few days, this chart is actually a few days old, but after the last few days rebound, I think from the low until now, 30% rebound already. But I think this should be the bottom for the Chinese equity markets. So that's the downside risk you're looking at. I think this is based on my observation. This what happened these few days is what I call the high volume sell-off. So what happened here is that a lot of people in China or Hong Kong, because they bought stocks using borrowed money, they use margin to buy stocks. They were forced to sell off the stocks because of margin call. Not because they wanted to sell stocks, because of margin call, they were forced to sell, and you saw the big dips in all the, especially those Chinese tech stocks, big retracement. Then subsequently, you see this big V-shaped recovery because a lot of people with cash, they know that these people are forced to sell. So people with cash are picking up all these good companies at very cheap prices, basically taking advantage of other people's unfortunate circumstances. So eventually the recovery was very swift. I think this will be the bottom for Chinese equities. I don't think it will drop more than that. Valuation wise also, this level is like, you can draw a line here. It's super cheap. Asia equities, I think similarly, this will be the bottom for Asian equities. So that's the potential downside risk that you're looking at, in my opinion. If China equity will perform strongly next year, how about China bond fund? Okay, good question. So we are actually positive in China bonds because we think that the Chinese government, in order to support the economy, because of the lockdowns, right, it will slow down the economy, right? So in order to boost the economy back to hit their GDP target, they will need to do other things. Okay, like for example, monetary policy or fiscal policy. So monetary policy, what they're doing in the past, they've been cutting interest rates in the recent times, and this will bode well for Chinese bond. Okay, but there's certain risks. Okay, ultimately, the Chinese property sector is still rather weak. Okay, some of the China bond funds have, or Asian high yield bond funds have underperformed this year because of defaults. So ultimately, it depends on the fund manager's skill to pick out those companies that are stronger and avoid those higher risk companies. Overall, the segment, the China bond segment, we are positive. The US earnings revision you showed are before target earnings warning. Based on this, will US earnings be revised, and yes, how much is the market still attractive? Okay. Yes, the target earnings warning just came recently only. So I don't think it's a big thing. Okay, because Target ultimately is a relatively smaller company compared to the other big heavyweights. So I don't think it will affect that much. Okay, I think there are a few more questions. Okay, I think I answered this. Price setter and price taker. Will you favor Malaysia semiconductor related companies? Yes, actually we have a detailed article on this. If you search our website, Malaysia tech sector, the most recent outlook, we have turned positive. Okay, they have retraced to very attractive levels already, especially with the structural growth drivers for technology and semiconductors going forward. Their earnings, their revenue orders will continue to post strong numbers, and the valuations have dropped a lot. In fact, you can refer to the article that we wrote recently. Okay, next. if existing portfolios are in negative territory, India, China, Asia, Japan, tech, where would you suggest averaging down, and how would the overall allocation for fresh funds? Especially India is looking less attractive compared to others. Okay, I would say, I think it will depend on how much allocation you already have in each investment that you have. If you already have a big allocation to China or tech, try not to increase the concentration risk to those. Then you can use the extra cash you have to average down on like Asia like that. So I think it depends on the situation. All of these are, I would say, good places to average down. It depends ultimately on your portfolio allocation right now. If you already have a very big tech exposure, I don't encourage to add more tech. Maybe you can use it to average down on Asia and Japan. Okay. I think that's all the questions. Yes. Okay, there's one more question. For every slide, can you let us know what is the key message? I think you just refer to the key takeaways here, then can already. Okay, so that's all, I believe. There's one more question. Okay, the previous bull run, I believe, driven by liquidity amidst quantitative easing, and liquidity going to suck out of the system. Will market go down further? Okay, if you look at the previous bull run is after COVID, right? Okay, if we look at the previous end of QE, we had a QE after global financial crisis, right? Then after that, the Fed stopped QE, right? Then they pull out liquidity. There was a market retracement, but subsequently, if you just look at the chart, markets after that still continue to rally because of fundamentals. So there would be a retracement, but ultimately, it's all back to fundamentals. We just use the previous post GFC QE, and then they stopped QE, markets retrace. Similarly, the Fed started to hike interest rate, but that doesn't mean that the market continue to go down, right? It actually continue to go up. So just look at the chart. Do I have a chart here? I don't have a US chart here, but okay, let's use a global equity chart. Let's see. Okay, this one. Yes. Okay. So yeah, after GFC, the Fed stopped QE, right? Okay. Then they hike interest rate, continue to hike interest rate until before COVID. So markets continue to rally, right? As you can see here. So it's just a temporary retracement. After that, it's back to fundamentals. Okay. I think that's all the questions. Thank you very much. We'll end the session already. Hopefully you all had a fruitful session. Thanks.
Jason, can you help me praise the last slide?
Last one. Okay, I think there's a promo going on. Yes, sorry about that. Yes. Okay, you want to talk a bit about this?
Okay. Before end our webinar, right? Today I would like to share currently our FSMOne run a promote is about the US and Hong Kong ETF RSP promote. For first 300 client enjoy a 0 processing fee on the first ETF RSP contract for the first year. This campaign, right, is valid for 20th of May 2022 until 17th of June 2022. And then if let's say you would like more know more about the information, you may refer to our FSM website, and then a replay of this section will be available right after this. You may proceed to our YouTube page FSMOne Malaysia to catch this replay. If you all have any further questions, feel free to send us an email at investhelp.my@fundsupermart.com. Once again, thank you very much, Jason, and thank you everyone for attending this section. Goodbye.
Bye-bye.
Bye-bye.